If you are new to investing, chances are you have heard two terms again and again: ETFs and mutual funds. They sound similar. They often invest in the same stocks. Yet, they work very differently. In this video, we will break it all down. Simply, clearly, no confusion. By the end of this video, you will understand what ETFs are, what mutual funds are, how they differ, and most importantly, which one might make more sense for you as an investor in the United States. Let's start with the basics. Both ETFs and mutual funds allow you to invest in a basket of assets. Instead of buying one stock, you buy many at once. This helps reduce risk and makes investing easier for beginners. Now, let's talk about mutual funds first. A mutual fund pools money for many investors. That money is managed by a professional fund manager who decides what to buy and what to sell. When you invest in a mutual fund, you do not trade it during the day. You buy and sell at one price only. That price is called the net asset value, or NAV. It is calculated once, at the end of the trading day. This means timing does not matter much with mutual funds. You place your order, and it executes after the market closes. For long-term investors, this simplicity can feel comfortable and predictable. Now let's switch to ETFs, or exchange-traded funds. ETFs also hold a basket of stocks or bonds. But here's the big difference. ETFs trade on the stock market, just like individual stocks. That means ETFs can be bought or sold anytime during market hours. Prices change in real time. You can see the price, place a limit order, and even react to market news instantly. This makes ETFs more flexible. They are popular with investors who like control, transparency, and the ability to react quickly. However, this flexibility can also tempt people to trade too often. Let's talk about fees, because fees matter a lot over time. Most ETFs have very low expense ratios, especially passive ETFs that track indexes like the S&P 500. Mutual funds, especially actively managed ones, usually charge higher fees. You are paying for professional management, research, and frequent buying and selling inside the fund. Over decades, even a 1% difference in fees can cost you tens of thousands of dollars. This is one major reason ETFs have become extremely popular in the US. Next, let's discuss tax efficiency. ETFs are generally more tax efficient than mutual funds. This is due to a special structure that reduces capital gains distributions. Mutual funds may pass taxable capital gains to investors when the fund manager buys or sells assets. Even if you did not sell your shares, you could still owe taxes. ETFs usually avoid this problem. This makes them attractive for taxable brokerage accounts, especially for long-term investors focused on after-tax returns. Now, let's talk about minimum investment requirements. Many mutual funds require a minimum investment, sometimes $1,000, sometimes even more. ETFs do not have minimums like that. You can buy a single share, or even a fraction of a share with many US brokers today. This makes ETFs very beginner-friendly. So, which one is better? The truth is, neither is universally better. It depends on your investing style, goals, and personality. If you prefer hands-off investing, automatic contributions, and professional management, mutual funds may suit you well, especially inside retirement accounts. If you value low fees, tax efficiency, and the flexibility to trade during the day, ETFs may be the smarter choice for you. Many successful investors actually use both: mutual funds for retirement plans and ETFs for taxable or personal investment accounts. The most important thing is not choosing ETFs or mutual funds. Is starting early, staying consistent, and investing with a long-term mindset. Because in the end, time in the market matters far more than trying to perfectly time the market. If you found this explanation helpful, consider subscribing for more simple, smart investing guides. Your future self will thank you.